Good day, fellow investors. I hope you enjoyed Berkshire's conference, but in this video I just want to discuss how Berkshire stock has been going up over the last 5 years, but now it might be that the fundamentals are catching up with the stock. When you have such a movement of a stock price over time, either the stock price will align with the fundamentals, or it is such a great business that the fundamentals will catch up with the stock price. And if we look at Buffett's summary presentation of Berkshire's earnings, we have operating earnings for the first quarter of the year at 11 billion. Berkshire includes taxes, interest, whatever in these earnings, and those are much higher than the same quarter of the past year. Thus, there is still growth in Berkshire, and the big bulk of that growth comes from insurance underwriting, but also the interest rates that Berkshire is getting on the huge cash pile. The rest is a little bit stable, and I must say I underestimated these insurance bonuses when I calculated Berkshire's growth ahead. I know that insurance is volatile, so it's hard to predict on those, but Berkshire is just being Berkshire and compounding on those earnings and cash flows. And here we can see the growth over the years, and that is something that I didn't expect, that rates of growth, but Berkshire, Buffett always positioning themselves in the right way for growing and compounding over time. The compounding increases the shareholders' equity. Don't get confused here with the ups and downs because of the stock market prices that go up and down on Berkshire's portfolio, but the key here is to know that there is now 182 billion of cash and treasury bills, likely some other cash around. The float keeps going up, and consequently all the profits are reinvested, and therefore over time the shareholders' equity is compounding, and that's why I'm saying how those profits are and the value is reaching to the stock price. There had been some buybacks up till 2022, and since then just a little bit, where Buffett now considers the stock overvalued for doing buybacks. However, if we look at the market cap of 875 billion and compare it to the operating earnings, it is not cheap, definitely not cheap, but it is already something for a great business like Berkshire is. And if we estimate the continuation of the good insurance numbers for the year, we get earnings, cash flows, which are usually the same for Berkshire, of 44 billion for the year. That is something staggering, and those 44 billion will quickly compound here, and therefore in the next few years, 4 or 5 years, shareholders' equity will be equal to current Berkshire market capitalization, which means that the fundamentals will reach the stock price, and therefore this is again a good investment even at these levels. Now, some people say, Sven, yes, but if you add the cash and treasury bills to the current equity, then the stock price will be reached. Yes, but don't confuse, those treasuries are creating investment income, and with 200 billion in cash, Buffett 5% interest rates, 10 billion will be just from bonds. And that's also why Buffett started selling Apple, because he's getting 5% of treasuries and just 3% of Apple. That is something that we'll discuss more tomorrow. So 44 billion increasing. The P ratio, when we compare it to the market cap, is still around 20. For an insurance business, for Berkshire, you better buy at a P ratio of 10 when there are some situations with insurance, etc. But If you start buying now, just from a strategic perspective, and then if the stock goes lower, you are willing to reinvest, buy more, I think that Berkshire is much better than many other investments out there to build wealth. And that is because Berkshire is a compounding machine, and you can invest in Berkshire, or you have to build such a compounding machine for yourself. All those cash flows coming in, bought at the right price, that is investing. That is what Buffett has been doing since like ever, and therefore here you have the results in the financial fortress that Berkshire is. And that's exactly what we discussed in the value investing video, with 8 key concepts that Buffett uses to create his portfolio, and those are the same that you can use to build long-lasting wealth, compounding wealth over time. Because this is the driver of your investment returns, the earnings that your portfolio is making, not the valuation. And that's why I believe that Berkshire now, at these prices, is a much better investment than the S&P 500 because of the compounding that it generates. It doesn't do buybacks. It is selling Apple because Apple is doing buybacks at these ridiculous prices. And that's why Warren Buffett doesn't like Wall Street, the S&P 500, because they are just spending money on buybacks to temporarily push the stock price higher. But that is not investing. Investing is book value, investing is compounding, is cash flows, exactly what Warren Buffett is doing. If you have any questions that you want me to discuss from the conference call, please put them in the comment section, and then we'll see if there is something worthwhile discussing. More about Apple and my research platform tomorrow. Thanks for watching. I'll see you in the next video.